Exactly a week after the Central Bank of Nigeria announced a flexible forex policy regime, the impact has been far-reaching on the economy and the financial markets. A major area for consideration is the Nigerian business environment, and the Director General of the Lagos Chamber of Commerce and Industry, Mr. Muda Yusuf, assesses the forex policy and gives his perspective on the implications for small, medium enterprises and businesses.
Well, the policy is a very good policy. It's a policy that we have canvassed over time. We have advocated for it because we believe that it will offer a more transparent framework for allocation of foreign exchange. It offers a more equitable framework for the allocation of foreign exchange to operators in the economy. Beyond that, one big advantage that the policy is bringing into the economy is the liquidity into the foreign exchange market. Because before now, we had a major liquidity crisis. And when I talk about liquidity, I'm talking about the ability to buy and sell foreign exchange as and when you need it. That was not in place under the previous regime. People had to queue, and when they even make a bid, sometimes they get about 10% of what they demand for. Sometimes they get about 20%. So it created a whole lot of problem. Businesses could not plan. There was scarcity, raw materials, and all of that. But with this new policy regime, what we expect to see is that there will be improved liquidity in the foreign exchange market. We also expect to see an improved inflow, of foreign exchange into the economy through the export proceeds, through diaspora remittances, through capital importation. Because as it is now, those who want to bring in such funds will be able to bring the funds at market rate, as against what the policy was, where those who are bringing in forex were compelled, to bring in the forex at the official rate of 197. The improvement that the policy will bring about on the supply side is likely to lead to a moderation of the exchange rate, especially in the parallel market. And we are beginning to see that even now. With the intervention and in the first day of trading, we see that the exchange rate interbank has come to around 281 or 285, as against 350, 360 that we saw in the parallel market. But of course, when you relate it to what we had in the official window, you could say it is a depreciation. But that window, that rate was actually not a realistic rate. And I know that most of the prices that you have in the economy have been defined by the parallel market rate. So the fact that you are seeing a moderation, I think, is a relief. Then there is also the revenue effect. When the central bank sells foreign exchange, there's a component of it that goes into the federation account. So at the time the CBN was selling at 197, there is very little it can remit to the federation account. But now that the CBN is selling at market rate, there's a good chance that what will go into the federation account from the CBN will be much more. And don't forget, even in the budget benchmark, the exchange rate assumption in the budget was 197. So if you now have a market rate for the exchange rate, that will mean that the revenue, the revenue side of the budget will also improve. Then there is the effect on the non-oil exports. Before now, export proceeds are to be exchanged at 197 or 200 at best, which was a major disincentive to exports, particularly non-oil exports, and which was why many exporters were reluctant to bring in their export proceeds. Some of them actually went underground and looked for other, creative ways to get the right value for their export proceeds. This policy has now said that all exporters will have unfettered access to their export proceeds. So in other words, if you have export proceeds in your dollar account, you are free to access it and sell it at whatever rate is prevailing. Then it will also bring about more certainty and improvements in investors' confidence. Investors can now plan because you are now sure that, okay, this is the rate, and if you bid, you are sure that you are going to get it at that rate. And there's also the futures element that has been introduced. In other words, if you are planning to buy FX maybe in 2 weeks' time, in a month's time, there is now opportunities for futures trading. All this will help to make planning easier. It will reduce uncertainty, and it will also reduce volatility, in the foreign exchange. So these are some of the benefits that this policy will bring to the economy, and it's already even showing. Look at also what is happening in the capital market. Because of the positive expectations, the indicators are already showing very positive signs. And we also expect some very good inflow of portfolio investment in the capital market. So these are some of the benefits. Now, the flip side of the policy, first, is that for mature obligations, there were some obligations that were pending for people to remit funds abroad. They are said they are finished with transactions. They have already lodged their deposits in the banks for onward transmission abroad for their suppliers. We had a huge backlog. Some people said it was about 5 billion US. Some said it was as high as $7 billion US. But all these were pending. And the CBN has said that there was no way it will make foreign exchange available at 197 or 200 to those pending transactions. So all those backlog will now have to fall back on the new foreign exchange policy in the new market, which is going to lead to a lot of shock. Because if you are doing a transaction at 197 or 200, and now you have to go and remit funds at 285, it's a huge shock. And that could even knock off some businesses completely. So that is one flip side. The other one has to do with the 41 items. The CBN is insisting that the 41 items will be excluded from the foreign exchange market. And many manufacturers have been complaining that some of their critical inputs are on the list of that 41 items, and that the CBN should please have a rethink on the 41 items. But as we speak, the CBN is adamant on the 41 items. So that is another major issue that some business operators have problems with concerning this policy. The implications for businesses is that, first, businesses that are resource-based are likely to benefit from this situation. When I say resource-based, businesses that are more dependent on local inputs, businesses that have high level of backward integration, they are likely to be more competitive under the present regime, because imports will remain expensive, will remain costly. That is why if you have businesses that are highly import dependent, the current policy will penalize them. So inherently, the current exchange rate policy favors businesses that are able to look inwards or that are able to substitute imports. That is one advantage, and that is part of the structural adjustment or the structural changes that we also desire, that more and more businesses should be able to look inwards. That is what this policy will also compel people to begin to do. And businesses that have high import content are also likely to be penalized, and their sustainability may also be challenged, because with high import content, the capacity to be competitive will be impaired. and that could create an issue, you know. The policy for the small business and the business environment, again, creates room for more certainty. It will be easier for businesses to plan now. The rate may be high, we are talking of 285, but at least you are sure of getting it. If you want to even do futures trading, you can do it. So planning will be much easier under the current dispensation than what we had in the past. So, and generally investments, because before now, a lot of businesses, particularly foreign investments, were reluctant to come in. But with this policy, a lot of foreign investors are now likely to come in, because they'll be able to bring in their foreign exchange at market rate. And the more investment that comes into the system, the better for the environment. Because this economy needs investment. We need private investment to power the economy. Government hasn't got the resources because of all these challenges of oil price and all of that. So the way to go, what can actually bring the desired changes in this economy, is private investment. So this policy environment will boost investment, and once we have this kind of improvement in the flow of investment, the economy benefits, and virtually all players in the economy will benefit from it.
In part 2 of this video, we will explore the forex policy and how it will affect sectors like manufacturing and import to export trading.